Welcome to HouseLux Estate, your go-to source for financial wisdom and real estate insights. We're here to guide you through a vast landscape of investment opportunities, from property purchases to stock market strategies. Our content covers a wide array of topics, all designed to help you navigate the world of finance and real estate with confidence and ease. Today, we delve into the world of retirement portfolios and how to build one with minimal risk. Before we dive into the nitty-gritty, it's important to understand what a retirement portfolio is. Simply put, a retirement portfolio is a collection of assets, such as stocks, bonds, and mutual funds, that you've set aside to fund your post-work years. It's like a financial safety net, cushioning you from the uncertainties of life after regular income stops. The purpose of a retirement portfolio is twofold. First, it aims to preserve your hard-earned wealth. Second, it seeks to grow that wealth over time, combating inflation and increasing your purchasing power in the future. Having a well-structured retirement portfolio is key to financial security during retirement. It provides a steady stream of income that can help cover daily expenses and unexpected costs. It can also allow you to enjoy the fruits of your labor and live comfortably during your golden years. Now that we've established what a retirement portfolio is, let's move on to why minimal risk is crucial. Risk can make or break your retirement portfolio, but why is that? Well, let's break it down. The role of risk in investments is like a double-edged sword. On one side, high risk can lead to high rewards, but on the flip side, it can also lead to substantial losses. Imagine your retirement portfolio as a ship sailing through the financial sea. High-risk investments are like stormy weather. They can capsize your ship if you're not careful. On the other hand, minimal risk investments are like calm waters, providing a smoother and safer journey. The potential consequences of high risk can be devastating, especially for retirees. You might lose a significant portion of your savings, and unlike younger investors, you may not have the time or resources to recover. The advantages of minimal risk? Well, they offer a more predictable return, and while the gains may be modest, they provide a sense of security and peace of mind. Knowing this, the question then becomes, how can one build a retirement portfolio with minimal risk? Our first step towards a minimal risk retirement portfolio is diversification. Now, you might be wondering, what exactly is diversification? Well, imagine you're at a buffet. You wouldn't just fill your plate with one type of food, right? You'd want a little bit of everything. That's exactly what diversification is. It's about spreading your investments across a variety of assets to reduce risk. Because, let's face it, having all your eggs in one basket can be quite risky. Diversification helps minimize risk through the magic of balance. If one investment is underperforming, another might be soaring high. This balance helps to smooth out the highs and lows of investing and keeps your portfolio steady even when the markets are not. So how do you diversify your portfolio? There are several ways to do it. Firstly, you can diversify across asset classes. That means you spread your investments between stocks, bonds, real estate, and even cash. Each of these asset classes has its own risk and return characteristics, and they often perform differently under various market conditions. Secondly, you can diversify within an asset class. For instance, within the stock market, you can invest in companies of different sizes, industries, and geographical locations. The performance of these companies often depends on different factors, so if one sector is doing poorly, another might be thriving. Lastly, you can diversify over time. This is known as dollar-cost averaging. By investing a fixed amount regularly, regardless of the market conditions, you buy more shares when prices are low and fewer when prices are high. This strategy can help reduce the impact of market volatility. But remember, while diversification can help reduce risk, it doesn't eliminate it. It's a strategy to manage risk, not a guarantee against loss. It's important to choose a mix of investments that aligns with your risk tolerance, financial goals, and time horizon. With diversification, your eggs aren't all in one basket, but there is another step to consider. Building a portfolio isn't a set-it-and-forget-it deal. Regular reviews are crucial. You wouldn't drive a car without regular checkups, would you? The same principle applies to your retirement portfolio. It needs regular maintenance to ensure it's performing optimally and in line with your retirement goals. So why are regular reviews important? Well, the financial market is much like a river. It's always moving, always changing. A portfolio that was balanced last year might not be balanced this year due to shifts in the market. Regular reviews allow you to assess the performance of your investments, identify any drift from your original asset allocation, and make necessary adjustments. But what exactly should you look for during a review? Firstly, you need to check if your portfolio is still aligned with your risk tolerance and investment goals. Has the value of one asset class grown more than the others? If so, your portfolio may be more exposed to risk than you'd like. Secondly, you need to consider changes in your life. Have your retirement goals changed? Maybe you're planning to retire earlier, or perhaps unforeseen expenses have cropped up. Your portfolio should reflect these changes. Now, when and how should you rebalance your portfolio? The when is usually dictated by significant changes in the market or in your life circumstances. The how entails selling investments from overperforming asset classes and buying more from underperforming ones. This can help to maintain your desired level of risk and return. Remember, rebalancing isn't about chasing returns. It's about realigning your portfolio with your goals and risk tolerance. It's more of a risk management tool than a way to maximize returns. One important caveat, though: rebalancing may incur transaction costs or tax implications. Therefore, it's crucial to consider these factors before making any decisions. Regular reviews keep your portfolio in check, but to ensure minimal risk, one must also consider the type of investments. So, as we venture into the next scene, let's delve into how to choose the right investments for your retirement portfolio. Not all investments are created equal, some are riskier than others. Now let's delve into the world of investments. Picture it as a vast ocean with a multitude of fish swimming around. Some are small, some are big, some are vibrant, and others are camouflaged. Each represents a different type of investment, and each carries a unique level of risk and potential return. First, we have stocks. These are shares in a company that you can buy, and they come with a moderate to high level of risk. Stocks can provide significant returns if the company does well, but they can also lead to considerable losses if the company performs poorly. Next, we have bonds. These are essentially loans you give to a company or the government. In return, they promise to pay you back with interest. Bonds are generally considered less risky than stocks, but offer lower potential returns. Then, we have mutual funds. These are a pool of various investments, including stocks and bonds. By investing in a mutual fund, you're spreading your risk across a wide range of investments, which can help lower your overall risk. Lastly, we have certificates of deposit and treasury bills. These are among the safest investments you can make, as they are backed by the government. However, they also offer the lowest potential returns. So, which of these investments are most suitable for a minimal risk retirement portfolio? Well, it's a mix. You want to balance the need for growth, which comes from riskier investments like stocks, with the need for safety, which comes from less risky investments like bonds and treasury bills. A good rule of thumb is to have a diversified portfolio. This means having a mix of different types of investments. Diversification can help you achieve a balanced portfolio, reducing risk while still providing the opportunity for growth. Remember, it's not about avoiding risk entirely, it's about managing it. You want your portfolio to grow, but you also want to protect it. And that's where choosing the right investments comes into play. Choosing the right investments can significantly lower your portfolio's risk. But remember, minimal risk doesn't mean no risk. Building a retirement portfolio with minimal risk may seem daunting, but it doesn't have to be. It's all about understanding the process, taking the right steps, and being consistent. We started off with understanding what a retirement portfolio is. It's not just a collection of investments, but a carefully planned strategy to ensure you have a steady income even when you're no longer working. The importance of minimal risk can't be overstated. It's about finding that sweet spot between risk and reward, ensuring the security of your hard-earned money while still providing room for growth. Diversification, as we've learned, is key. It's like not putting all your eggs in one basket. By spreading your investments across different asset classes, you reduce the risk of losing everything if one investment goes south. Regular reviews and rebalancing are crucial too. The market changes, and so should your portfolio. Regularly assessing your portfolio and adjusting it to maintain the right balance between different investments ensures that it stays aligned with your retirement goals. And finally, choosing the right investments is the backbone of a solid retirement portfolio. It's about understanding your risk tolerance, your retirement goals, and choosing investments that align with these. With these steps, you're well on your way to a secure retirement. Don't forget to subscribe to HouseLux Estate for more financial wisdom. Until next time.